Governments are borrowing more money than ever, and for the first time in history, they are not afraid. Debt no longer triggers panic. It no longer collapses markets. It no longer ends political careers. What once signaled danger now signals control. This video explains how fear disappeared from global finance, why debt became a tool of governance, and why the moment governments stop fearing debt is the moment risk becomes invisible. For most of modern economic history, government debt was not a neutral variable. It was a constraint. Excessive borrowing triggered consequences that were immediate, visible, and often brutal. Markets reacted, currencies weakened, interest rates surged, and political careers ended. Debt was feared because it imposed discipline. That fear shaped behavior at every level of the system. In the post-war economic order, sovereign debt carried an implicit warning. Governments could borrow, but only within limits set by confidence, inflation, and capital mobility. Investors demanded compensation for risk. Interest rates rose as debt increased. This mechanism enforced restraint without legislation. The market acted as an external regulator. Debt crises followed a predictable pattern. Borrowing expanded during growth, limits were reached, confidence eroded, and adjustment followed. Sometimes the adjustment came through default, sometimes through inflation, sometimes through austerity, but it always came. Debt could be postponed, but not ignored. This dynamic was visible across continents. Latin American debt crises in the late 20th century demonstrated how quickly capital could flee. European sovereign stress showed how markets punished fiscal imbalance. Emerging economies learned that borrowing in foreign currency carried existential risk. Developed nations understood that credibility was fragile. Interest rates were the core enforcement tool. When debt rose too quickly, borrowing costs increased. Higher rates constrained fiscal space. Governments were forced to choose between reform, austerity, or restructuring. Political pain followed economic excess. This link was clear, and it was feared. Monetary policy reinforced this discipline. Central banks prioritized price stability and credibility. They did not act as unconditional lenders to governments. Debt monetization was taboo. Inflation was treated as failure. The separation between fiscal ambition and monetary restraint maintained balance. Economic data reflected this reality. Debt to output ratios were monitored closely. Credit ratings mattered. Downgrades increased borrowing costs. Fiscal rules existed not as symbolic commitments, but as market necessities. Ignoring them invited punishment. This fear shaped political decision-making. Governments avoided sustained deficits because they understood the consequences. Borrowing was justified as temporary. Long-term imbalance was politically dangerous. Even powerful states respected these limits, not because they were written, but because they were enforced. The system was imperfect, but it was coherent. Debt created growth in moderation and crisis in excess. Markets enforced discipline. Governments responded. Adjustment occurred cyclically. Pain was concentrated, but it was not indefinite. The psychological impact of this framework was profound. Voters associated debt with instability. Inflation memories reinforced caution. Political rhetoric emphasized responsibility. Even when governments borrowed aggressively, they framed it as exception rather than norm. This environment began to change gradually, not suddenly. The shift did not start with abandonment of discipline. It began with intervention justified as emergency. Each crisis expanded the acceptable boundary. Each intervention reduced fear incrementally. The first major inflection occurred when central banks intervened to stabilize financial systems directly. Liquidity provision expanded. Asset purchases normalized. Temporary measures persisted longer than expected. The line between emergency and standard policy blurred. Yet even then, debt still carried stigma. Governments justified borrowing as necessary but dangerous. Exit strategies were promised. Normalization remained the stated goal. Fear still existed, even if it weakened. Over time, repeated interventions altered expectations. Markets learned that authorities would act to prevent collapse. Investors adjusted risk assessments. Interest rates remained low despite rising debt. The enforcement mechanism softened. As confidence and intervention grew, fear diminished. Borrowing increased without immediate consequence. Political costs declined. Debt no longer triggered rapid adjustment. The old feedback loop weakened. This was not accidental. It was cumulative. Each crisis rewrote precedent. Each response recalibrated limits. The system evolved from discipline enforced by markets to stability managed by policy. Economic statistics captured the shift. Debt levels rose without proportional increases in borrowing costs. Inflation remained contained despite expansion. Currency crises became less frequent in developed economies. The historical relationship between debt and punishment broke down. This transformation changed behavior fundamentally. Governments discovered that debt no longer imposed immediate pain. Voters did not feel the cost directly. Markets did not revolt. The old fear lost credibility. But this did not mean that debt became harmless. It meant that its consequences were delayed, redistributed, and obscured. The cost did not disappear. It moved. Understanding this distinction is critical. The danger is not that governments borrow more. The danger is that the mechanisms that once enforced restraint no longer operate in the same way. When fear disappears, behavior changes. Constraints weaken. Trade-offs are postponed. Debt becomes routine rather than exception. Political incentives shift accordingly. This is the moment the system now occupies. A world where debt no longer scares governments is not a world without limits. It is a world where limits are no longer visible. And invisible limits are the most dangerous kind. Because when fear disappears before constraint does, imbalance grows quietly. And when adjustment finally arrives, it no longer looks like the past. The moment debt stopped behaving like a threat was not marked by a single decision or announcement. It emerged gradually, through a series of policy choices that permanently altered the relationship between governments, markets, and money. What changed was not the amount of debt alone, but the mechanism that once enforced consequences. The critical shift occurred when central banks moved from indirect influence to direct intervention. In earlier systems, monetary authorities influenced conditions through rates and liquidity signals, but they did not actively absorb government liabilities at scale. That boundary dissolved under crisis pressure. Once crossed, it was never fully restored. When financial systems faced collapse, central banks intervened to stabilize markets rather than allow adjustment. They purchased government bonds, suppressed yields, and ensured continuous access to funding. These actions were framed as temporary. In practice, they rewrote expectations permanently. Markets learned a new lesson. Sovereign debt in advanced economies was no longer priced primarily on fiscal fundamentals. It was priced on institutional backing. The buyer of last resort was no longer private capital. It was the monetary authority itself. This altered risk perception fundamentally. Interest rates lost their disciplinary function. Borrowing costs no longer rose in proportion to debt levels. Governments could expand deficits without triggering immediate market reaction. The traditional feedback loop between excess and punishment weakened dramatically. Economic data reflected this break. Debt ratios climbed steadily while yields remained historically low. Rating downgrades lost impact. Inflation failed to respond as expected. The old models no longer explained outcomes. What once would have triggered crisis became routine. This environment encouraged a profound behavioral shift. Policymakers began to treat debt as a manageable variable rather than a constraint. Borrowing decisions were framed around political necessity rather than market tolerance. The assumption changed from how much can we afford to how much is required. Fiscal policy expanded beyond countercyclical support. It became structural. Deficits persisted during growth periods. Emergency spending morphed into baseline expenditure. The line between stimulus and normal policy disappeared. Central banks reinforced this behavior through signaling. Forward guidance emphasized support and flexibility. Markets were reassured that intervention would continue as long as necessary. This reduced uncertainty, but it also reduced restraint. Inflation targets were reinterpreted. Temporary overshoots were tolerated. Structural price pressures were reframed as transitory or acceptable. The fear of inflation lost urgency compared to the fear of instability. This reprioritization altered policy calculus. Global coordination amplified the effect. Major central banks acted in parallel. Policy divergence narrowed. Capital had fewer alternatives. The absence of external discipline reinforced internal confidence. Debt expanded across advanced economies simultaneously. The political implications were immediate. Borrowing no longer carried visible cost within electoral cycles. Spending could increase without immediate taxation. Pain was deferred. Accountability weakened. Debt became politically attractive. Voters experienced benefits without clear trade-offs. Social programs expanded. Economic shocks were softened. Employment stabilized. The system appeared resilient. Few questioned sustainability because consequences were invisible. The concept of normalization faded. Exit strategies were discussed but postponed. Each attempt to reduce intervention encountered resistance from markets and politics alike. Dependency formed quietly. This dependency reshaped market psychology. Investors stopped demanding risk premiums for sovereign debt. Volatility declined. Stability became expected. The absence of fear reinforced itself. At the same time, debt management techniques evolved. Governments rolled obligations indefinitely. Maturity profiles extended. Refinancing replaced repayment. Debt became perpetual in practice, if not in name. This did not eliminate cost. It transformed it. Inflation absorbed part of the burden. Currency dilution redistributed impact. Asset price appreciation benefited holders. Savers bore erosion quietly. The system functioned because costs were dispersed. No single group felt the full weight. This diffusion reduced resistance. Debt expanded without triggering collective response. Critically, this was not deception, it was design. Policymakers understood that visible austerity carried political risk. Invisible adjustment was preferable. Debt enabled this strategy. Economic news reinforced complacency. Markets rallied despite deficits. Growth persisted despite imbalance. Crisis narratives lost credibility. Debt ceased to frighten because it ceased to bite immediately. But this new equilibrium carried hidden fragility. It relied on confidence in institutions, coordination among authorities, and tolerance of gradual erosion. It assumed stability would persist indefinitely. This is the foundation of the current system. Debt does not scare governments because the mechanisms that once enforced fear have been neutralized. The threat did not vanish. It was postponed, diffused, and reallocated. Understanding this transformation is essential. It explains why debt levels that once would have caused panic now generate little reaction. It explains why borrowing feels safe. It explains why restraint feels unnecessary. But safety built on postponed consequence is not the same as safety built on sustainability. The old system punished excess quickly. The new system absorbs it quietly. And in that quiet absorption, risk does not disappear. It accumulates. As debt expanded under this new framework, the most striking change was not fiscal behavior, but market behavior. The traditional guardians of discipline did not revolt. Bond markets did not panic. Currencies did not collapse. Instead, tolerance replaced resistance. This was the moment when debt truly stopped being feared. Markets adapted faster than narratives. Once it became clear that central banks would absorb pressure indefinitely, pricing models adjusted. Risk was no longer evaluated based on debt levels alone, but on institutional credibility. The question shifted from how much governments owed to who stood behind them. This fundamentally altered sovereign risk assessment. Advanced economies with strong monetary institutions were treated as effectively insulated. Debt issuance was assumed to be supported. Yields reflected policy stance rather than fiscal balance. Markets no longer demanded compensation for excess borrowing. They assumed continuity. This assumption became self-reinforcing. Low yields reduced debt servicing costs. Lower costs justified higher borrowing. Higher borrowing did not raise yields because support remained intact. The feedback loop reversed. Instead of debt increasing risk, debt appeared to reduce it by anchoring policy commitment. Rating agencies adapted reluctantly. Downgrades lost influence. Credit assessments acknowledged rising debt but emphasized institutional strength. Fiscal metrics became secondary. Credibility replaced constraint. Markets followed this logic instinctively. Inflation dynamics further delayed consequence. Despite massive borrowing, price pressures remained muted for extended periods. This reinforced confidence that debt had lost its danger. Policymakers cited structural forces, demographics, and globalization as justification. The absence of immediate inflation validated intervention. When inflation eventually emerged, the response was measured. Authorities framed it as manageable. Markets accepted this framing. Yields rose only modestly. Fear remained contained. The belief that intervention would prevent disorder held. The real cost of debt shifted quietly. Savers experienced erosion through negative real returns. Wage growth lagged asset appreciation. Purchasing power declined unevenly. These effects were gradual and dispersed. No single constituency felt acute pain. Asset holders benefited disproportionately. Low rates inflated valuations. Real estate, equities, and financial assets appreciated. Wealth concentrated. The system transferred debt cost upward through assets and downward through purchasing power erosion. This redistribution reduced political resistance. Those with influence benefited. Those who bore cost lacked visibility. Adjustment occurred without protest because it lacked a focal point. Debt became socially tolerable because its burden was invisible. Global coordination reinforced complacency. Major economies expanded debt simultaneously. There was no alternative benchmark. Capital had nowhere else to enforce discipline. Coordination removed comparative pressure. Emerging economies experienced a different reality. Without reserve currencies or credible institutions, debt still carried consequences. This divergence reinforced the belief that debt was safe for some and dangerous for others. The system became stratified. This stratification mattered. It taught policymakers in advanced economies that they operated under different rules. Debt limits were no longer universal. They were conditional on status. This emboldened borrowing further. The narrative adjusted accordingly. Debt was reframed as investment. Deficits were justified as necessary. Balance sheets were discussed in aggregate rather than constraint. The language of caution faded. Markets internalized this language. Fear was replaced by expectation. Intervention became the baseline. Stability was assumed. The absence of fear became rational within the system as it existed. But this rationality depended on continuous coordination, institutional credibility, and public tolerance. It assumed no major breakdown in trust. It assumed political cohesion. It assumed that adjustment could always be delayed. This is where danger resides. When fear disappears completely, behavior becomes linear. Borrowing expands without contingency. Trade-offs are ignored. Resilience is assumed rather than built. The system functions not because debt is harmless, but because belief is strong. Confidence substitutes for discipline. Trust replaces restraint. This works until it does not. The historical difference is subtle but critical. In the past, debt created crisis by triggering panic. In the present, debt creates risk by suppressing panic. Adjustment is delayed rather than avoided. Delayed adjustment is not free. It accumulates pressure. It concentrates consequence. When confidence weakens, reaction may be abrupt because correction was postponed for too long. This does not mean collapse is imminent. It means sensitivity increases. The system becomes more dependent on credibility. Any shock that threatens trust carries outsized impact. Debt no longer scares governments because markets no longer scare governments. Markets no longer scare governments because markets no longer believe discipline applies. This is the new equilibrium. It is stable but conditional. And conditions change faster than belief. When belief shifts, fear returns. But it no longer looks like it used to. It arrives later, moves faster, and carries more weight. That is why debt without fear is not safety. It is postponed consequence. And postponed consequence never disappears. When debt loses its immediate consequences, the system does not become reckless overnight. Instead, it enters a phase where borrowing appears sustainable, rational, and even virtuous. This is the most dangerous moment because excess no longer signals itself through stress. It hides behind stability. Governments did not stop caring about debt entirely. They stopped fearing it. That distinction matters. Fear once enforced prioritization. Without it, trade-offs blur. Borrowing becomes the default solution to every structural problem because it postpones cost and preserves political calm. The mechanics of debt without consequence rely on continuous rollover. Governments no longer plan for repayment in any meaningful sense. Debt is issued to service existing obligations. Maturities are extended. Interest payments are managed through suppression of rates rather than reduction of principal. This transforms debt from a liability into a permanent feature. Economic statistics reinforce the illusion. Debt-to-output ratios stabilize or rise slowly. Servicing costs remain manageable. Markets remain calm. Headlines emphasize resilience. The absence of crisis validates policy choices. Stability becomes proof of correctness. But stability under intervention is not the same as stability under balance. The system functions because it is actively supported. This support suppresses signals that would otherwise indicate stress. The result is a misreading of risk. Inflation plays a central role in this process. Rather than triggering alarm, moderate inflation becomes a release valve. It erodes real debt quietly. It redistributes burden across the economy. It allows adjustment without explicit default. Policymakers prefer this outcome because it avoids confrontation. This preference reshapes decision making. Inflation tolerance increases. Price stability becomes flexible. Targets are reinterpreted. What would once have been considered failure is reframed as manageable friction. The system absorbs cost gradually. At the same time, fiscal expansion becomes politically efficient. Borrowing finances, social stability, employment support, and strategic investment. These policies generate visible benefits. The costs remain abstract. Debt enables governance without sacrifice. This dynamic encourages structural complacency. Reforms that impose short-term pain are postponed. Productivity enhancements that require disruption are avoided. Debt fills the gap. It becomes a substitute for change. Markets reinforce this behavior. As long as yields remain contained, borrowing appears rational. There is no market incentive to restrain expansion. Risk premiums do not rise. Capital continues to flow. This creates a paradox. The more debt accumulates without consequence, the more confidence increases. Confidence encourages further borrowing. The system feeds itself. The illusion of sustainability becomes embedded. Policymakers cite historical comparisons to justify expansion. They point to low rates, strong institutions, and currency dominance. These arguments are not false. They are incomplete. Sustainability is measured not by ability to borrow, but by ability to adjust. A system that depends on continuous support narrows its margin for error. Each intervention increases dependency. Each delay increases sensitivity. Debt without consequence alters expectations across the economy. Households adapt to permanent support. Businesses assume policy backstops. Investors expect intervention. These expectations shape behavior in ways that increase systemic rigidity. Rigidity is the hidden cost. Flexibility declines. Policy options narrow. When conditions change, adjustment becomes more difficult because the system has not practiced restraint. International dynamics amplify this effect. When major economies expand debt simultaneously, comparative discipline disappears. No single actor fears capital flight. Coordination removes pressure. However, this coordination masks divergence. Some systems absorb debt more effectively than others. Demographics, productivity, and institutional strength matter. Uniform borrowing produces unequal outcomes. Over time, this inequality grows. Economies with stronger fundamentals sustain debt longer. Others accumulate fragility. The global system becomes uneven, but calm. This calm is misleading. It is not equilibrium. It is managed tension. Pressure accumulates beneath surface stability. Economic news cycles reflect this distortion. Headlines focus on resilience, not imbalance. Short-term indicators dominate. Structural metrics fade from attention. Debt becomes background noise. This environment rewards short-term optimization over long-term planning. Political cycles reinforce this bias. Leaders prioritize continuity. Debt supports this strategy. But continuity purchased through borrowing is conditional. It assumes stable institutions, cooperative markets, and public tolerance. None of these are guaranteed indefinitely. The true danger of debt without consequence is not insolvency. It is misallocation. Resources flow toward maintenance rather than transformation. Growth potential erodes slowly. Productivity stagnates. Innovation slows. Competitive position weakens. These effects do not trigger panic. They accumulate quietly. As debt grows, the system becomes less capable of generating the growth needed to justify it. This is the core contradiction. Borrowing sustains stability, but undermines dynamism. Eventually, debt becomes a signal not of strength, but of avoidance. It indicates unresolved structural issues. It reflects postponed decisions. At this stage, the system still functions. Markets remain calm. Governments remain confident. Fear remains absent. This is precisely why the danger intensifies. Because when consequences are delayed long enough, adjustment does not disappear. It concentrates. And when concentration replaces diffusion, stability becomes fragile. Debt without consequence is not free. It is cumulative. And accumulation always has a limit, even when no one is watching. As debt accumulates without immediate financial consequence, its burden does not disappear. It relocates. The system does not eliminate costs. It redistributes it across time, classes, and institutions. This redistribution is the hidden mechanism that allows debt to persist without fear. The first group to absorb the cost is households through purchasing power erosion. When inflation becomes the adjustment tool, wages lag prices. This lag is subtle, uneven, and rarely framed as debt-related. Consumers experience higher costs of living without a clear cause. Debt becomes invisible in daily life, even as it reshapes it. Savings suffer quietly. Low or negative real returns erode accumulated capital. This does not trigger outrage because it lacks a single moment of loss. Instead, value dissipates gradually. The cost of debt is paid not through default, but through dilution. Asset holders experience a different outcome. Low rates inflate valuations. Equities, real estate, and financial assets appreciate. Wealth concentrates. This is not an accident. It is a structural feature of debt-driven stabilization. Asset inflation absorbs adjustment pressure while maintaining the appearance of prosperity. This divergence alters social dynamics. Those with assets perceive stability and growth. Those without experience stagnation. The system appears functional from above and constrained from below. This asymmetry reduces political urgency. The beneficiaries of the system exert greater influence than those bearing its cost. Labor markets reflect this shift. Employment stability is prioritized over wage growth. Governments support jobs through borrowing. Workers remain employed, but purchasing power declines. This trade-off is politically acceptable because it avoids visible unemployment. Debt finances calm, not advancement. Corporate behavior adapts accordingly. Firms leverage low borrowing costs to refinance rather than innovate. Share buybacks and asset consolidation outperform productivity investment. Debt enables financial optimization at the expense of long-term growth. Markets reward this behavior. Public services absorb pressure differently. Governments maintain social programs through borrowing rather than reform. Quality stagnates, access narrows, efficiency declines, but continuity is preserved. Debt sustains function while deferring improvement. Generational effects compound these trends. Younger cohorts inherit higher debt without corresponding asset ownership. Entry into housing and capital markets becomes more difficult. Opportunity narrows. Frustration grows slowly. Debt becomes an intergenerational transfer mechanism. Politically, this environment is deceptively stable. There is no singular crisis to mobilize reform. Discontent fragments. Polarization increases. Narratives compete, but structural causes remain obscured. Debt remains an abstract concept. Internationally, the cost distribution follows similar patterns. Reserve currency issuers externalize part of their adjustment through global inflation and capital flows. Peripheral economies experience volatility and constraint. The global system absorbs debt asymmetrically. This asymmetry reinforces hierarchy. Countries with monetary credibility borrow freely. Others face limits. The perception that debt is safe applies selectively. This stratification encourages further borrowing at the core and restraint at the margins. Markets internalize these realities. Risk pricing reflects power rather than balance. Sovereign debt becomes a political asset. Confidence substitutes for fundamentals. As long as institutions hold, fear remains suppressed. However, suppression is not resolution. Social tolerance has limits. Purchasing power erosion eventually becomes visible. Asset inequality becomes politically salient. Generational imbalance produces tension. These pressures do not originate in bond markets. They emerge in society. This is the critical shift. Debt no longer threatens governments through markets first. It threatens them through legitimacy. The danger moves from finance to politics. When legitimacy erodes, policy flexibility collapses rapidly. Intervention becomes less effective. Confidence weakens. Markets respond belatedly but forcefully. Adjustment accelerates. This is why debt without fear is not stability. It is delayed accountability. The longer accountability is deferred, the sharper its eventual expression. The system survives by dispersing cost. But dispersion cannot continue indefinitely. Eventually, costs align. They become visible. They become concentrated. And when that happens, debt does not announce itself through yields. It announces itself through trust. When trust breaks, markets follow. Debt no longer scares governments because fear has been redirected. But redirected fear does not vanish. It waits. and when it returns, it no longer asks permission. Once debt stops triggering immediate market punishment and begins reshaping society itself, governments face a new calculation. Borrowing is no longer merely tolerated, it becomes the most efficient political instrument available. This is the stage where debt evolves from financial tool into governance strategy. Modern governments operate under constant pressure. Voters demand stability, employment, social protection, and growth simultaneously. Structural reform, by contrast, delivers pain first and benefit later. In democratic systems with short electoral cycles, this asymmetry is decisive. Debt offers an escape. It allows governments to deliver benefits now and defer costs beyond the political horizon. This is not ideological failure. It is rational behavior within the system as it exists. When borrowing no longer provokes crisis, it becomes the least disruptive option. Cutting spending creates backlash. Raising taxes provokes resistance. Reform threatens incumbents. Debt avoids all three. Fiscal expansion, financed by borrowing, smooths economic cycles. It absorbs shocks without visible sacrifice. Governments stabilize employment through subsidies. They protect households through transfers. They support industries through targeted spending. Each intervention reduces volatility. Each intervention increases dependency. Economic statistics appear to validate this approach. Growth remains positive. Unemployment stays contained. Financial markets remain calm. Debt ratios rise, but servicing costs remain manageable. From a policymaker's perspective, the system works. This reinforces political incentives. Success is measured by avoidance of crisis rather than resolution of imbalance. Leaders are rewarded for continuity. Debt becomes the mechanism that sustains continuity. Public discourse adapts accordingly. Borrowing is reframed as investment. Deficits are justified as necessary. Long-term sustainability is acknowledged abstractly, but rarely prioritized. The narrative emphasizes resilience over responsibility. Institutional language evolves. Emergency measures lose their exceptional framing. What was once temporary becomes permanent infrastructure. Fiscal stimulus becomes fiscal architecture. Debt finances the baseline. Central banks enable this transformation, intentionally or not. Their commitment to stability reduces market discipline. By ensuring liquidity and suppressing yields, they remove immediate constraints. Governments respond predictably. The coordination between fiscal authorities and central banks tightens. While formal independence remains, practical alignment increases. Policy becomes symbiotic. Monetary support enables fiscal expansion. Fiscal expansion justifies monetary support. This alignment reduces the perceived risk of debt further. Markets internalize coordination as guarantee. Sovereign borrowing is priced not on balance sheets, but on policy cohesion. As long as institutions act together, fear remains absent. Political systems quickly learn this lesson. Debt is no longer a sign of weakness. It is a sign of capacity. Governments that borrow are seen as proactive. Those that restrain are criticized for inaction. This dynamic shifts competition between states. Borrowing becomes a tool of geopolitical positioning. Debt finances strategic industries, energy transitions, defense, and technology. Fiscal restraint is reinterpreted as vulnerability. Global news reflects this shift. Major economies announce massive spending programs without triggering panic. Deficits expand in response to crises and remain elevated afterward. The absence of immediate consequence normalizes behavior. The electorate experiences benefits unevenly but visibly. Jobs are preserved, services continue, shocks feel contained. The connection between debt and future cost remains abstract. Political support remains intact. This creates a reinforcing loop. Debt stabilizes society. Stability preserves political power. Political power sustains debt. The system becomes self-sustaining. Importantly, this does not require deception. Voters are not misled deliberately. The cost of debt is genuinely difficult to perceive in real time. Inflation, asset redistribution, and currency dilution operate gradually. Responsibility diffuses. Structural reform becomes increasingly unattractive. Its benefits are uncertain and delayed. Its costs are immediate and concentrated. Debt offers certainty. It guarantees calm. As a result, governments prefer debt even when they understand its long-term implications. The choice is not between sustainability and irresponsibility. It is between visible pain and invisible cost. Political systems choose invisibility. This preference shapes institutional culture. Ministries plan with borrowing as assumption. Budgets incorporate deficits as norm. Long-term projections rely on continued support. Contingency planning narrows. The danger lies not in borrowing itself, but in the erosion of alternatives. When debt becomes the only acceptable instrument, flexibility declines. Policy space shrinks despite apparent abundance. Over time, governance becomes reactive rather than proactive. Problems are managed through spending rather than solved through restructuring. Debt becomes anesthetic. This anesthetic effect is powerful. It suppresses urgency. It delays confrontation. It maintains order. But anesthetics do not heal. They mask symptoms while underlying conditions persist. The longer they are applied, the harder recovery becomes. At this stage, governments are not reckless. They are trapped by incentives. Debt no longer scares them because it no longer threatens their position in the short term. On the contrary, it protects it. This is the core political logic of modern debt. It buys time. It preserves calm. It avoids conflict. And that is precisely why it is preferred. Because in systems where fear has shifted away from markets and toward society, debt is not weakness, it is control. Every strategy built on debt as a governing tool eventually confronts limits. These limits are not fixed thresholds written into law or spreadsheets. They are systemic constraints that emerge when political logic collides with economic reality. The danger of debt-driven governance is not that it fails suddenly, but that it exhausts its own effectiveness. The first limit appears in policy saturation. When debt is used repeatedly to neutralize every disruption, its marginal impact declines. Each new borrowing program stabilizes less than the previous one. Public expectations rise faster than policy capacity. What once calmed markets and society becomes baseline noise. This erosion is subtle. Governments continue to spend, but outcomes weaken. Growth generated by borrowing becomes thinner. Employment protection grows more expensive. Social transfers stabilize consumption, but fail to improve productivity. Debt shifts from catalyst to maintenance cost. At this stage, fiscal expansion no longer buys progress. It buys time. And time, once purchased continuously, becomes more expensive with each cycle. The second limit emerges in monetary dependence. Debt-driven governance relies on sustained monetary accommodation. Low yields are not optional. They are structural. Any meaningful increase in borrowing costs threatens the entire framework. This creates a dangerous asymmetry. Monetary authorities retain formal independence, but practical flexibility narrows. Tightening policy risks destabilizing public finances. Loosening policy reinforces dependency. The corridor for error shrinks. Markets sense this constraint. Confidence persists not because fundamentals improve, but because intervention is assumed. This assumption holds only while credibility remains intact. Once doubt enters, reaction accelerates. The third limit is inflation credibility. While moderate inflation absorbs debt quietly, persistent inflation erodes trust. Price stability is not merely an economic variable. It is a social contract. When households perceive loss of purchasing power as permanent, tolerance declines. Governments respond by reframing inflation rather than resolving it. They emphasize external shocks, transitions, and temporary pressures. Initially, this works. Over time, repetition weakens persuasion. Inflation shifts from explanation to grievance. This is where political cost re-enters the equation. Debt was preferred because its cost was invisible. Inflation makes cost visible. Once visible, it becomes contested. Debt loses its political advantage. The fourth limit lies in distribution. Debt-driven stabilization disproportionately benefits asset holders and institutional actors. As inequality widens, legitimacy erodes, social cohesion weakens. Borrowing sustains the system, but fragments society. Fragmentation reduces governability. Polarization increases. Consensus becomes harder to maintain. The very calm debt was meant to preserve begins to fracture. At the international level, limits appear through confidence asymmetry. Reserve currency issuers enjoy greater tolerance, but not immunity. Global capital flows respond to relative credibility. When coordination weakens or geopolitical tension rises, debt tolerance declines unevenly. External shocks accelerate this process. Energy disruptions, trade fragmentation, or geopolitical conflict increase fiscal strain. Borrowing must rise to absorb shocks. This tests the outer boundary of tolerance. Importantly, these limits do not arrive simultaneously. They accumulate. Each reduces maneuverability, each increases sensitivity. The system remains functional, but brittle. This brittleness is the hidden cost of political reliance on debt. The more debt is used to govern, the less capacity remains to respond when governance itself is challenged. At this stage, governments face a narrowing set of choices: continue borrowing and risk legitimacy erosion, attempt restraint and face immediate backlash, reform and absorb pain, or manage decline. History suggests that systems rarely choose reform voluntarily at this point. Adjustment is delayed until constraint becomes unavoidable. By then, options are fewer. Debt no longer scares governments because it no longer threatens power immediately. But power preserved through borrowing becomes fragile. It depends on confidence, coordination, and tolerance simultaneously. When any one of these weakens, debt loses its protective function. It stops buying time and begins consuming it. This is the paradox of debt as governance. It creates stability by postponing reckoning, but postponement magnifies reckoning. The longer debt is used to avoid conflict, the more conflict accumulates beneath the surface. And when political logic finally meets economic constraint, adjustment does not negotiate, it asserts itself. Debt does not collapse systems on its own. It reveals the limits of systems that relied on it too long. And when those limits appear, fear returns. Not to markets first, but to politics. Because at that point, debt no longer governs the system. The system governs the debt. When governments lose fear of debt, the final transformation is not fiscal, it is psychological. The system stops treating borrowing as an emergency measure and begins to treat it as an operating condition. This is the moment when debt becomes permanent architecture rather than temporary response. At this stage, policy no longer asks whether borrowing is justified. It asks whether borrowing is sufficient. Budget debates focus on allocation, not restraint. Deficits are assumed. Balance becomes theoretical. The question shifts from sustainability to manageability. Economic planning adapts accordingly. Long-term projections no longer include debt reduction as a core objective. Instead, they assume continued rollover, stable rates, and persistent intervention. Growth forecasts incorporate structural deficits as baseline. The system plans around debt rather than against it. This planning framework changes institutional behavior. Finance ministries focus on market access rather than consolidation. Debt offices prioritize maturity extension rather than repayment. Fiscal credibility is measured by refinancing capacity, not by balance. Markets accept this framework because it aligns with observed behavior. As long as refinancing succeeds, sustainability is assumed. The absence of default reinforces confidence. Each successful issuance validates the model. This creates a new equilibrium. Debt does not constrain policy. Policy constrains perception of debt. As long as confidence holds, the system appears stable. But this equilibrium depends on conditions that are rarely stated explicitly. It requires persistent monetary accommodation. It requires political cohesion. It requires social tolerance of gradual erosion. And it requires absence of competing narratives. The first vulnerability emerges when these conditions are questioned. Not broken, but questioned. Doubt does not need to dominate. It only needs to exist. Economic data becomes contested. Inflation is no longer dismissed as temporary. Growth figures are reinterpreted. Debt metrics regain attention. Narratives fragment. Confidence weakens incrementally. Markets react not to numbers, but to tone. Communication missteps matter more than fundamentals. Credibility becomes fragile. Policy errors carry outsized impact. This is where the danger of normalized debt resides. The system is not designed for reversal. It is designed for continuation. When continuation becomes uncertain, adjustment lacks structure. Governments respond predictably. They borrow more to stabilize perception. They intervene to restore calm. They reinforce the very mechanism that is under question. This can succeed temporarily, but it accelerates dependency. At the same time, external pressures intensify. Demographics worsen fiscal ratios. Aging populations increase spending obligations. Productivity growth remains constrained. The capacity to outgrow debt diminishes. Global conditions compound these pressures. Trade fragmentation raises costs. Energy transitions require massive capital. Geopolitical tension demands defense spending. Each priority is funded through borrowing. Each reduces fiscal flexibility. Economic news reflects this accumulation. Headlines report record spending, historic deficits, and unprecedented commitments. Markets remain calm, but the scale becomes normalized. Normalization is the signal. This is the stage where debt stops being controversial. It becomes boring. And boring risks are the most dangerous because they attract no attention. Institutional memory fades. Policymakers who remember a crisis retire. New leaders inherit stability without context. The lessons of restraint lose relevance. The system becomes confident in its own design. This confidence is not irrational. It is supported by experience. Crises were avoided. Stability was preserved. Intervention worked. The model delivered results. But success creates blind spots. The system confuses postponement with resolution. It assumes that because adjustment has been delayed repeatedly, it can always be delayed again. This assumption is the core risk. It is not mathematical, it is behavioral. Debt itself does not trigger collapse. Loss of adaptability does. A system that relies on one instrument loses optionality. When debt is the only solution, it becomes a vulnerability rather than a strength. This is where the final contradiction emerges. Debt was embraced to preserve stability. Over time, it reduces resilience by narrowing responses. The system remains functional. Markets remain calm. Institutions remain credible. But the margin for error shrinks quietly. And when margins shrink, events that once were manageable become defining. This is not a forecast of collapse. It is a description of condition. A world where debt no longer scares governments is a world where fear has been postponed, not eliminated. And postponed fear, when it finally returns, does not negotiate. The final stage of a debt-normalized system is not collapse, default, or panic. It is adjustment under constraint. When fear has been postponed long enough, the system does not explode, it tightens. And tightening reshapes outcomes across governments, markets, and societies simultaneously. For governments, this phase removes illusion. Borrowing remains possible, but its effectiveness declines sharply. Each additional unit of debt produces less stability and more friction. Political leaders discover that debt no longer buys consensus. It buys time only at rising cost. Policy becomes defensive. Budgets prioritize protection over ambition. Spending shifts from development to maintenance. Fiscal choices grow narrower. Trade-offs that were deferred return compressed into shorter horizons. Adjustment becomes unavoidable, even if it avoids the language of austerity. The key difference from historical debt crises is sequencing. Markets do not lead adjustment. Politics does. Pressure emerges through inflation persistence, social dissatisfaction, and declining trust. Financial reaction follows legitimacy erosion, not balance sheet deterioration. This inversion matters. Governments accustomed to market-driven signals struggle to respond to social constraint. Tools designed for liquidity fail to address confidence. Monetary accommodation cannot restore trust. Fiscal expansion cannot resolve distribution. Central banks face their most difficult environment. They must balance inflation credibility against fiscal sustainability. Any decisive action risks destabilizing one side of the system. Neutrality becomes impossible. Policy choices become explicitly political, even if framed as technical. Markets react selectively. Volatility increases, but not universally. Capital concentrates in assets aligned with policy protection, scarcity, or institutional backing. Peripheral assets suffer. Liquidity fragments. Correlation rises where policy converges and breaks where credibility diverges. Investors adapt by abandoning binary thinking. There is no singular collapse scenario. There is no clean recovery. Performance depends on alignment, duration, and optionality. Static strategies fail. Flexibility becomes dominant. At the corporate level, survival depends less on efficiency and more on relevance. Firms embedded in strategic priorities persist. Those dependent on discretionary demand struggle. Consolidation accelerates. Competition narrows. Innovation becomes incremental and defensive. Labor outcomes reflect similar compression. Employment remains supported, but advancement slows. Wage growth remains constrained. Security replaces mobility. Inequality hardens structurally. Opportunity becomes inherited rather than created. Social tolerance erodes unevenly. There is no universal revolt. there is gradual disengagement. Trust declines. Participation weakens. Political fragmentation increases. Governance becomes harder, not because institutions fail, but because legitimacy thins. Internationally, the system fragments further. Coordination weakens under stress. Currency credibility diverges. Debt tolerance becomes conditional. Capital flows favor perceived stability, not growth. The global order becomes more hierarchical. At this stage, the role of debt is fully revealed. It was never a solution. It was a bridge between fragility and endurance, a bridge between crisis and adjustment, a bridge designed to buy time. Time was bought, but time was not used to remove constraint. It was used to delay confrontation. Now confrontation returns, not as panic, but as pressure. The danger is not default, it is loss of agency. A system accustomed to postponement struggles with inevitability. When choices narrow, reaction accelerates. The absence of fear earlier produces sharper response later. This is why a world where debt no longer scares governments is more dangerous than it sounds. Fear once enforced discipline. Its absence removed early warning. Adjustment arrives later, faster, and with fewer options. Debt did not fail. It succeeded too well. It stabilized markets. It preserved institutions. It delayed collapse. But it also delayed adaptation. And systems that delay adaptation long enough eventually adapt under constraint. The lesson is not moral, it is structural. Debt without fear does not eliminate limits, it hides them. And hidden limits are discovered only when they are reached. By then, choice is no longer strategic, it is reactive. This is the true legacy of debt without fear, not crisis, but constraint. And constraint always arrives quietly first. Debt did not break the system, it stabilized it. But stability built on postponed consequence is not strength, it is delay. The world did not remove limits, it hid them. And when limits are hidden, they are only discovered when they are reached. This was Shadow Rewind.